Welcome back to Cheddar. I'm Vanessa Freeman.
And I'm Nora Ali. We're just about 5 minutes away from market close, so let's bring in some guests to discuss what we can expect here. Joining us now for a roundtable discussion on what to expect at the close, Jim Bianco, President and Macro Strategist at Bianco Research, and Caleb Silver, Editor-in-Chief at Investopedia. Great to have you both with us here today. Jim, we'll start with you. Stocks cratering today, seems to be holding steady though in the last minutes of trade. All 11 sectors in the S&P 500 are down. Can you react to the day that we've had so far on Wall Street?
One of the weirdest days that I've seen in probably my career. Normally when you get a day like today, which would rank in the top 20 of the biggest declines in the post-World War II period, 27,000 trading days, this is in the top 15, you would expect it to be a little bit more chaotic than it is right now. That's worrisome. That means that maybe we haven't found a bottom yet, and we've got a little bit lower to go.
Caleb, let's bring you in here. What is it about today's environment that does make today feel different from what we felt in recent history? Obviously, a lot of volatility, unknown factors like coronavirus, oil prices sinking. It contextualized for us why today is different.
Well, as you mentioned earlier, every asset, every sector in the S&P is down. Obviously, that was predicated on oil's massive decline, but almost every security, minus U.S. Treasuries and gold, is getting hit right now. Jim puts it in good perspective. It seems orderly, and maybe that's because where you have such a big passive investing base, there's so many ETFs there that are used as hedging tools, and maybe that makes it seem a little bit more orderly. But it feels like there's a real capitulation going on, and investors don't want to hold anything right now. No cryptocurrencies. It's really the very few safe havens that people are holding on to, and the rest is really being thrown out.
And Caleb, does it have to be something this big, a global pandemic, to end a bull run?
Why not? I mean, a global pandemic that doesn't really have any solutions in store. World health officials have not, first of all, identified a cure or been able to show what stops the decline. We are seeing, a slower rise or a leveling off in China, which is a good sign, but that just means the rest of the world and those developed economies that have now been exposed to coronavirus and have fatalities and mounting cases, those could grow geometrically, and that's a huge concern.
And Jim, we've seen some action even from safe haven assets that's a little bit unpredictable at this point. We saw the price of gold even decline last week. And then as people are fleeing to safe havens, we're seeing the yield on 10-year treasuries at historic lows, hitting below 0.4%. We're talking basis points at this point. What does this kind of say about investor sentiment in the long term, looking out beyond the next couple of months even?
Well, I think that what you're seeing in most of the markets is a general repricing. I hate to put it this way, but we know where we're going with this virus, and we don't like it, and we don't want it to be that, but it is, and that is widespread economic disruption is coming, just like it is in northern Italy, just like it was in China, just like it will be in a lot of other places. And that's the way that this market is trading. And as Kev said, there's no magic headline that's going to stop this. There's going to be no cure. There's going to be no vaccine. So we're not going to get that headline. There's nothing else the president can say or any world leader can say that makes this go away. We're going to have to live with this disease. And this has got the markets worried, and that's why you see this massive rush into safe assets, because it means a big contraction is coming for not only earnings, but the economy in general.
And Caleb, let's talk oil. Is this price drop here good for consumers?
Well, theoretically, but what we have here is a supply shock and a demand shock. So a demand shock in that people need less oil if they're going to be less travel, international travel, cargo shipping. But on the supply side, there's plenty of it, and there's a huge disagreement between OPEC and OPEC Plus, and that's unraveled the oil market in a big way. So you normally say this is going to translate to lower gas prices. It will in about a week or two here in the U.S. We've already had pretty low gas prices, which has propped up the consumer. But I don't think this is going to help consumers. I think they're going to get scared and pull back.
So we're just about 30 seconds away from market close, guys. So stick with us, but we are seeing the Dow, it's declining a little bit faster than a few minutes ago, nearing in on 2,000 points down. It looks like we are going to close the day at least 7.5% in the red for the Dow specifically. The Russell 2000, though, down more than 9%. All right, so ringing the closing bell here on the floor of the New York Stock Exchange on this historic day is Dell Technologies. And then over at the Nasdaq Women in ETFs, ringing that closing bell. Let's take a quick look as the big board settles where the markets close. The Dow indeed closing down more than 2,000 points, down 7.8%. Remember, it was that 7% decline earlier this morning that triggered that circuit breaker to pause trading for 15 minutes. The Russell 2000 closing down more than 9%, down 136 points. The S&P 500 down 7.6%. Let's take a quick check at the Nasdaq as well. The Nasdaq also deep in negative territory, closing down 7.3%. So let's bring our guests back in here just as an immediate reaction here. Jim, we'll go over to you. Is this expected? I mean, we have been using the word recession so frequently. We talked to the president of the New York Stock Exchange earlier today. She said this is how markets move. We've seen high valuations. We've seen record after record on the upside. So is this kind of what you might expect?
Yeah, I think it is. By the way, this will either be the 6th or 7th worst decline in the World War II era, depending on how we run it off right now. But this is the way that the markets realize something has changed. There was a set of circumstances 2 weeks ago in the economy, and now markets forward-looking are saying that those set of circumstances no longer apply. You could see it in the payroll report on Friday, how it was summarily ignored. It was probably one of the best payroll reports we've ever seen. And it's looking forward and saying there's a new set of circumstances coming as we go forward, and it's repricing up and down the line for that. So yeah, this is the way it should work. We may not like it, but it is what it is.
Jim, with all these, having the markets close, or sorry, let's bring Caleb in for this question. Seeing markets close, the Dow closing down more than 2,000 points, seeing, as we mentioned earlier, Treasury yields at historic lows for the 10-year and 30-year Treasuries, what do you expect going forward? Have we reached a bottom, or is this the beginning of a new horizon, a new reality? As Jim had pointed out, something does feel different.
Yeah, I think Jim's nailed it. I think it's very different, and it's just a repricing of assets. It's a rethinking of the way the global economy works, which since the World War II era, even before that, has been predicated on fossil fuel consumption, fossil fuel production and exploration. Look at what's happened into the oil sector. Even before this disagreement, oil stocks and the oil sector itself was down precipitously. This just takes us down even further, and we'll have to rethink the New World Order. How is Russia and Saudi Arabia going to interact with each other now that they seem to be broken apart? But now that we have this enormous leveling of oil prices, how does that make its way through the rest of the economy? And I wouldn't say it's the bottom. I say we're in for some choppy times, and I wouldn't be surprised to see another leg down.
Yeah, on the point of oil prices, Jim, we're seeing this price war. We're seeing potentially Saudi Arabia trying to win this price war, gaining market share from maybe its U.S. competitors. How much longevity do these countries have in participating in this price war? And do you see any of the players maybe coming out stronger on the other side of this, even though this is contributing to so much kind of fear at this point?
Oh, I think that this price war has the potential to last for quite a while. I think the Saudis and the Russia, this is about Saudi Arabia and Russia. This is not about the United States. And the first casualty will probably be Iran, because they were reeling already with the virus, and that they've had big production cuts because of sanctions, and now they're going to get much less for their oil. I think that those two are going to fight it out in a big way. They're going to see who could pump more oil. The price of oil will go down. For the U.S. economy, it will be a small net, excuse me, a small net negative. It will help the consumer, but we have a very large energy sector, especially in the shale area, and it will be devastated from this. There'll be widespread bankruptcies. There'll be widespread chaos in the energy sector. So net, it will help one sector, hurt another sector, but on balance, probably be a small drag for the U.S. economy. It's not something necessarily to celebrate unless you only care about how much you pay at the pump. There's a lot of people in the energy patch that are going to be hurt by this, and hurt by this badly as they fight it out.
Yeah, and guys, just to put this into context, to confirm, this is the biggest one-day percentage drop for the Dow, S&P 500, and Nasdaq since December 1st, 2008. We've been talking about the financial crisis and making those comparisons recently. We saw the worst week since the financial crisis just a couple of weeks ago. What are the similarities here? We'll go to Caleb for this one. What are the similarities to the financial crisis, and should investors be expecting more of a decline in that respect right now?
Well, they should be expecting more of a decline just because it's been so volatile and the trend has been down. So even when stocks were starting to come back a little bit last week, the lows came in lower and that's nothing, you don't want to see that in terms of momentum. There's a big difference between today and 2008, 2009. That was a liquidity crisis predicated on an oversupply and too many houses being sold by consumers that couldn't afford it, and banks pushing those products at them. We don't have that situation right now. We have maybe a stock market that was overheated and overvalued, but that was predicated on low interest rates, and there was no place else to put your money but stocks to earn a return. And now that the profit forecast looking forward is in doubt for much of the entire S&P and every super sector within it, investors are repricing those assets. It's not about an oversupply of housing. We got a supply problem and a demand problem that started with coronavirus, and now the oil situation is just going to make it worse. That's the only similarity.
Now, Jim, reportedly, President Trump is set to meet with Wall Street execs over the coronavirus fears. What do you think will come of this, or what are you hoping to hear on the other side of this meeting?
I think it'll be probably a stock salesman pitch that the U.S. economy is okay, and you should go out and buy stocks, is what you're going to probably hear from President Trump. I don't think that that's going to do much of anything. But what I would like to hear from Wall Street execs is how much more pain can they withstand? If the stock market goes down another 10 or 15% from here, are we going to run into liquidity problems or solvency issues on Wall Street? That it's not a concern now, but given the speed of this decline, look, it was only 13 trading days ago that we made the all-time high. We're down 18% in 13 days. That's the fastest off of an all-time high in history. And so when you start making those kind of historical moves, you got to start worrying if Wall Street is not prepared for such a black swan event in terms of the markets. And are they going to be okay if it continues to sink lower and lower? So I'd like to hear them address that. I doubt very much they will, though. With President Trump, it'll all be, seashells and balloons, and everything is going to go higher, and you should buy stocks.
Seashells and balloons, haven't heard that one before. But Caleb, Trump meeting with Wall Street execs kind of reminds me of him meeting with tech execs in the height of the U.S.-China trade tensions, just trying to understand, or, on the surface, trying to understand where they're coming from. To that point, are there any learnings from the U.S.-China trade war thus far, whether it's how closely tethered the global supply chain is, how reliant the U.S. is on China, that can be applied to the coronavirus situation? And do you expect companies to make longer-term changes to maybe not rely so much on China?
Well, it's going to be hard to do that. We are China's biggest customer. China's our biggest customer. So unraveling those ties will be very disruptive to U.S. companies and to Chinese companies. We already saw it in the beginning phases of the trade war. Some of that sort of improved as we got closer to phase one on the agreement, but everything that was agreed to basically doesn't even matter anymore because we're facing a global crisis right now in both the economies and the capital markets in almost every developed country right now. So don't expect them to fulfill any of the obligations from phase one. I think we're going to push all those out. What he can do is make sure that banks are all in line with regulators to add liquidity if necessary. We know that the Federal Reserve has already cut rates. It'll probably cut them again. It may even cut them twice in the next couple of months. That helps a little bit in easing up money. But the real issue here is the confidence and whether or not consumers are going to lose that confidence as they get more and more scared and start to pull back their spending. That held up the economy and the stock market in 2019. We're not going to have that in 2020.
And to that point, Jim, do you think the Fed is going to look to cut interest rates even further at that March meeting?
Not only cut interest rates at the March meeting, but the market right now is pricing in that they're going to cut them to zero. And so I think you should expect that. I think the Fed's been getting a bit of a bad rap here. Everybody says, well, rate cuts can't help, rate cuts can't fix it. The Fed never promised that rate cuts could be a substitute for a vaccine, but it is what the Fed can do, is cut rates and provide liquidity. They already did it this morning by expanding the amount of repurchase agreements that they will provide to the primary dealers. And I suspect they'll do it again by cutting rates rather aggressively at next week's meeting. And I think they can go all the way to zero and just be done with it at that point and then open the door to more quantitative easing after that.
Yeah, on that note of moving rates potentially to zero, Caleb, we know President Trump has even asked for negative interest rates, which some countries have done, Japan, some countries in Europe specifically. What would be the implications in the U.S., not necessarily negative interest rates, but if we do get very, very close to zero on that Fed funds rate?
That's the $70 trillion question, because our U.S. Treasuries, especially the 10-year, but most of the longer duration ones, are widely held by institutions and pension funds and governments around the world. So when you get rates that low, we may be the cleanest dirty shirt in the hamper, but we have no idea what that actually looks like because we've never been down to these levels. Will they continue to want to hold U.S. Treasuries? Probably, because it's the safest asset on the planet right now, but there may be a turning of the tide in terms of their willingness and their appetite for that type of security going forward. If that happens and they start to sell it, will fiscal policy kick in, and will we have to do more quantitative easing so there is a buyer for those assets, because that greases the entire wheel of the financial system. If that goes and we start to see a bailout of those assets, we're going to have trouble like we've never seen before.
Jim, final word on the implications of a 0% interest rate in the U.S.?
It will be stressful for the banking system. If we were to go to negative interest rates, I don't want to see negative rates, but I wouldn't rule it out. It could be very stressful for the banking system. If you look at Japan and Europe, when they went to negative rates, it wreaked havoc on their banking systems. But the Fed might feel compelled to try and act extraordinarily and do something like that. So 0 should be the absolute limit. It won't be good for banks, but I'm afraid that they may not stop there if this thing continues to metastasize into something worse.